Welcome, curious minds, to another deep dive. Today, we're embarking on a mission, really, to cut through the noise, bypass the jargon, and give you a real shortcut to understanding what's truly happening with Citizens Development Business Finance PLC, or CDB. We're diving deep into their interim financial statements for the period ended June 30, 2025. Whether you're getting ready for a big meeting maybe, or you're just incredibly curious about how financial institutions tick, we're here to distill the most important nuggets of knowledge from these detailed documents. We'll be looking at everything from their earnings to their overall financial health, their cash flow, and yeah, even who owns a piece of this company. Get ready for some genuine aha moments.
Indeed. And these interim statements, they're more than just numbers. They offer a crucial window into a company's strategic moves and, well, its immediate health. Our goal today is to focus not just on what the numbers say, but really why those numbers matter to you.
Okay, let's unpack this then. Let's start with their performance, the statement of profit or loss. When we look at the period ending June 30, 2025, the big headline seems to be robust revenue growth. We're seeing a solid 11% increase in overall revenue compared to the same time last year. It's hitting almost 6.9 billion rupees.
That's right. And what's truly fascinating here is how that revenue is being generated. Their net interest income, which is, essentially the profit they make from lending money versus what they pay on deposits, that's an impressive 18% jump.
18%.
Yeah, that tells us their core business of lending is performing quite well.
But it's not just about interest, is it? I noticed they're also seeing some really dynamic growth in other areas. Their fee and commission income that could come from services like processing loans or maybe wealth management that soared by 40%.
40%, yeah.
And their other operating income grew even faster by nearly 50%. That seems like a strong sign of diversified business.
It really is. This diversification, especially the strong growth in fee and commission and other operating income, it's a positive signal. It means CDB isn't, putting all its eggs in one basket. It makes their business model more resilient, less reliant solely on that traditional interest income.
Okay, so with all this revenue growth, particularly from those diversified streams,
Yeah.
what's your take on how this ultimately impacts their bottom line? Are we seeing that translate directly into stronger profits?
We are actually. We see their profit before tax climb by a healthy 19%, landing them with over 1.2 billion rupees. Their profit for the period was up 16%, and basic earnings per share, which is obviously key for investors, also rose nicely. However, and this is crucial, we need to look at the accompanying increases in expenses.
Right.
Personnel expenses were up a significant 27%, and total operating expenses climbed 20%. And critically, impairment charges and other credit losses surged by a massive 74%.
74%, wow.
Yeah. Think of impairment charges as the money they have to set aside for loans that might not get repaid. This really significant increase raises an important question. While revenue and profit are growing, are the underlying costs of doing business, particularly related to potential credit risk, also accelerating?
So a healthy rise in profits overall. But as you highlighted with those expense increases, especially impairments, there's maybe a flip side to this good news. Having looked at their earnings, what I'm keen to understand next is how all this activity impacts their overall financial strength, what they own and owe. Are they building a robust foundation, or is this aggressive growth perhaps coming at the expense of stability?
Let's turn to their statement of financial position, essentially their balance sheet, to see the company's asset health.
Good idea. The balance sheet gives us that snapshot, of what they own and owe at a specific point in time. And their total assets, they expanded significantly, growing from roughly 157 billion rupees at the end of March to nearly 168 billion by June 30th.
Okay, so that's a jump of over 10 billion rupees in just 3 months. That's quite a bit. It is.
And if we connect this to the bigger picture, the most striking part of that asset growth seems to be the substantial expansion in loans and receivables to customers. I mean, the money they've lent out. That jumped from around 111 billion rupees to almost 124 billion rupees. That feels like a huge surge in their lending activities.
It absolutely is.
Interestingly, they also more than doubled their loans and receivables to banks, which is the money they've lent to other financial institutions.
Right. This shift in asset composition really suggests an aggressive deployment of funds into earning assets, primarily loans. Now, on the liability side, the money they owe also increased.
Good.
We see a significant jump in amounts due to banks and financial institutions. That's the money they've borrowed from other banks, rising from about 32 billion to nearly 39 billion rupees. Customer deposits also increased, though maybe a bit more modestly, to over 87 billion rupees.
Got it. And on the equity front, That's what shareholders truly own, right?
Exactly. Total equity saw healthy growth there, pushing the net assets value per share up nicely from about 338 rupees to 352 rupees.
Okay. That's certainly a positive sign for investors. Now, profit is one thing, but as they say, cash is king. Let's talk about the statement of cash flows. This tells us the actual money moving in and out, not just what's recorded as profit. For this period, CDB reported a net cash used in operating activities of over 5 billion rupees. That's a substantial increase from about 1.7 billion rupees used in the same period last year. So much more cash is flowing out of operations.
Yeah, that immediately raises an important question, doesn't it? What's driving this increased cash outflow from operations? And the statement clearly shows a massive outflow related to net funds advanced to customers, which jumped from about 4.7 billion to over 13.5 billion rupees.
13.5 billion.
Yes, this is really the primary reason for the negative operating cash flow. It indicates they are pouring a significant amount of money into new loans, aggressively expanding that lending book.
So they're lending a lot more, which naturally eats into their operating cash. Okay. But their investing activities actually generated a net cash inflow of nearly 2.7 billion rupees. Looks like that was largely due to proceeds from other investment securities, maybe selling off or maturing some other financial holdings.
Exactly. While their core lending activities consumed a lot of cash, they managed to offset some of that by generating cash from their investment portfolio. However, it's worth noting, cash flow from financing activities, which includes things like issuing debt or receiving new funds from shareholders, that decreased significantly compared to the prior year.
Right. So ultimately, looking at the overall picture here, CDB saw a net decrease in their immediate cash equivalents by over 1.1 billion rupees for the period,
Correct.
leaving them with roughly 3.1 billion rupees at the end of June. It certainly paints a picture of a dynamic dance.
Yeah.
Aggressive lending, funding that growth partly through borrowing, and some strategic asset shifts.
That's a good way to put it.
Okay, that gives us the big picture. But financial institutions are complex, right? They often have different engines driving their growth. Let's maybe peel back another layer and look at the different segments of CDB's business and their key financial health metrics. See which parts are truly shining. The segmental analysis shows CDB operates across lease and stock out on hire, loans and advances, and others.
And looking at that, it's quite clear that the loans and advances segment is the primary growth engine for the company right now. Its segmented revenue saw a significant increase, and critically, its segmented assets nearly doubled. Growing from about 35 billion rupees to over 64 billion rupees.
Wow.
In contrast, the lease and stock out on hire segment, which involves leasing vehicles or equipment, actually saw a slight decrease in revenue. So it really confirms their strategic focus is heavily on traditional loans.
Okay, that makes sense given the cash flow picture too. Now, shifting to some key regulatory performance indicators. Let's talk asset quality. This is about how healthy their loan book is. Yeah?
Precisely.
The gross non-performing accommodations ratio, that's the percentage of loans where payments are significantly overdue. It's slightly improved from 6.32% down to 6.24%. That sounds like a small step in the right direction, at least on the surface.
It does, but while the gross ratio saw that marginal improvement, other asset quality metrics show a more nuanced picture.
Oh, okay. How so?
Well, the net non-performing accommodations ratio, that's the amount of bad loans after accounting for money they've set aside for them, that actually edged up slightly from 3.10% to 3.25%. And the provision coverage ratio, which tells us how much money they've put aside for potential loan losses compared to the total bad loans, that also decreased from 52.5% down to 49.50%.
Okay, so the net bad loans ticked up a bit, and the coverage for those bad loans went down.
Exactly, and that's an important distinction. It suggests that while the total non-performing assets might be proportionally stable or slightly better, the actual coverage for those potentially problematic loans has slightly reduced. Or you could say the net amount they stand to lose has increased relative to their total loans. It's a subtle but potentially crucial shift to watch.
That's a really important distinction you're making there, especially given the rapid loan growth. Okay, what about liquidity? How much quick cash do they have on hand?
Liquidity ratios look robust, comfortably above the regulatory minimums. They have available liquid assets at over 161% of what's required, which is well above the 100% minimum.
Okay, so plenty of buffer.
Yes, but it's worth noting this buffer has decreased from about 191% in the previous quarter, March 2025.
Right.
So the company remains highly liquid, absolutely, but the immediate cash cushion is slightly less than it was 3 months prior.
Okay. And capital adequacy. That's their measure of how well capitalized they are to absorb unexpected losses or risks.
Capital adequacy remains strong. It signals financial stability. Both their core capital to risk-weighted assets ratio and total capital to risk-weighted assets ratio are comfortably above the regulatory minimums.
Good.
For example, core capital is 13.61% against a 10% minimum required, so a healthy margin. Although, like liquidity, these ratios have slightly decreased from March, they still represent a very healthy financial cushion.
Got it. Finally, let's quickly touch on profitability metrics again, some of the ratios. We see a slight dip in net interest margin, which is that spread they earn on lending, down from 7.97% to 7.60%.
hmm
And both return on average assets and return on average equity also saw a slight decrease. But on the positive side, their cost-to-income ratio improved slightly from 48.48% down to 47.69%, so a bit more efficient there.
That's right. The decline in those main profitability ratios, despite the strong revenue growth we talked about earlier, it suggests that the cost of generating that income has risen. Or perhaps those asset quality nuances we noted are beginning to impact the bottom line a bit more significantly this quarter. But as you said, the slight improvement in the cost-income ratio does indicate some operational efficiency gains, which is definitely a positive countertrend in this dynamic financial picture.
Okay, let's wrap things up by looking at the ownership structure and, maybe more excitingly for some, how the market is viewing CDB's shares. The top 20 shareholders for ordinary voting shares are listed. Looks like Solinco Life Insurance Limited holds the largest single stake at over 31%. Other prominent institutional investors are there too, and key figures, including the managing director CEO, Mr. WPCM Nanayakara, also hold significant shares.
Yeah, this type of concentrated ownership by institutional investors and key management is quite common for publicly traded companies like this. It's also important to note the public holding percentage. It's robust, nearly 47% of ordinary voting shares, and a substantial 80.5% of non-voting shares are held by thousands of public shareholders.
Right.
That signifies a healthy level of public participation and liquidity in the stock.
And for those listeners who track market performance, the share prices. Wow, they've seen a dramatic increase. The last traded price for ordinary voting shares at the end of June was 392.50 rupees. That's nearly double the 210 rupees it was a year prior.
A huge jump.
And non-voting shares saw an even more dramatic rise, going from 105 rupees to over 300 rupees in the same period. That's almost tripling.
That's really very strong market appreciation. It clearly reflects significant investor confidence in the company's performance and its prospects. And we also know from the explanatory notes that a cash dividend of 10 rupees per share for both voting and non-voting was approved and paid shortly after this reporting period ended.
Good context. Lastly, it's probably worth just mentioning their external credit rating from Fitch Ratings Lanka Ltd BBP Belga with a stable outlook. That gives you, the listener, a quick, independent snapshot of their perceived creditworthiness and financial stability.
Phew, what a deep dive. We've really journeyed through CDB's interim financial statements. We uncovered impressive revenue and profit growth, especially driven by that loans and advances segment and those diversified income streams. We also navigated the shifts in their balance sheet, showing that aggressive expansion in lending, which consequently impacted their operating cash flow as they poured money into new loans.
And we examined that nuanced picture from their key performance indicators. Strong capital and liquidity, absolutely, but also those interesting movements in asset quality and that slight moderation in profitability ratios. These dynamics really highlight a company that's actively growing its loan book, performing, I think you called it, a delicate balancing act between expansion and diligently managing risk and efficiency.
Well put. This brings us then to our provocative thought for you to mull over. Considering CDB's significant increase in lending activities and those concurrent shifts we discussed in asset quality metrics, how might you, as an informed observer, assess the balance between their aggressive growth strategy and their risk management approach going forward? What specific metrics would you prioritize watching in their next financial report to really confirm their trajectory? Something to think about. Thank you so much for joining us on this deep dive. We hope this exploration has given you a clearer, perhaps more nuanced understanding of these interim financial statements. Until next time, keep learning.